Okay, it's 6:15. We're gonna get ready for the presentation in about 14 minutes now. Just want to make sure everything's working. We can cut this part of the presentation off. Want to welcome everybody that's here so far. We'll be starting in about 3 minutes. If you have any questions, please put them in the Q&A box. Question was, do we have a table for the UBIT tax? And actually, you'll have a couple of slides in here. And if anybody wants a copy of the slides or any of the tools that you'll see us working with, you'll be able to write engage at camaplan.com and ask for what you want, and we'll send you a copy of the presentation or any of the tools you request. Let us know. All right, at this point, it's 6:30, so I'd like to get started with our UBIT, what it is and how it works. This is the second in the summer series that National RIA has engaged us to teach and provide for its members. So UBIT can be helpful. Here's a question to think about. Should you use all your money to buy one property or split it up and buy two or more? Right? Think about what's your cash on cash return. Does it make sense to have a higher cash on cash return, but less cash flow? That's your choice. We have people that will buy a single house, have no mortgage on it. And then others that'll take the money that they spent on that one house and buy four, putting down 4 down payments and having 75% loan to value. We'll look at some examples today. I'm not going to go through every number on the tax returns, but I'm going to give you a feel for what it takes with UBIT. And again, don't think UBIT's always bad. I think in a lot of cases it's great. One other example is we used to have people that would take over houses for just the payments and basically be in it for 99.9% financed, and or would all of the money would be subject to unrelated business income tax or taxable income. So at this point, let's kind of get through the slides here. Now I'm having a hard time changing the slides. There we go. So disclaimer, Camaplan doesn't provide any investment advice. We're not attorneys. We're not CPAs. We don't offer any investment or sell any products. We're a neutral third party administrator of the IRAs. We don't endorse anyone or any investment, but we're glad to work with you and your team of advisors. So with that, ask your questions away and we'll see where we are. Again, most of you saw this slide last month. Myself, I grew up in Fort Lauderdale. I went to Cornell University, graduated in structural engineering, then went to Kennedy Space Center and worked on the R&D programs for the shuttle, and then commercial space flights with the Titan program at Cape Canaveral Air Force Station, and some military secret missions. I'm a Camaplan co-founder out of 2004. So this is our 20th anniversary this year in August. I am also a real estate investor. I still own rental property. I'm sizing it down from, I think, 9 states to probably 2. I've been married to my wife, Vicky, since 1981. We had 4 boys and 8 grandkids. And I've been working with the IRAs for almost 30 years at this point. So I think that qualifies me to talk a little bit about the UBIT, et cetera. So let's go to the definition, right? Because people get these confused a lot of times, right? UBIT, unrelated business income tax, right? Taxable versus tax advantaged plans, tools, we'll go over. We'll talk about the definition of UBIT and UDFI versus 401k exemptions. We're going to go over some specific examples of K1s, not in the details of all of them, but just to let you know whether or not you are subject to UBIT. We'll talk about non-recourse loans, and we'll go over trust rates, long-term and short-term. Who calculates the UBIT, who pays it, and when, and then we'll go over questions and sessions from that advantage. This chart here was one that I talked about last year. Last month, and I said I'd bring it up for presentations. Sorry. And what happens is you can change this number here. You can change your tax bracket. You can change the return that you get in this year and this point. You can change the number of years you want if you want to go into specifics. But I'll show you just one example. If you put in $200,000 today, and you made 5% on it, in 20 years, it'd be almost $400,000 in this session here. The IRA is going to be $530,000 just because of the difference in not having to pay the taxes and more money to invest in those 20 years. If you made a 10% return on that in the blue column, in that same 20 years, that 200,000 would be 773 versus in the IRA it'd be worth 1.3 million. And then obviously if you do 15% in the taxable account, it's going to be worth 1.4, and in the IRA it's going to be worth 3 million. You can change any of these numbers. We'll give this tool to you. Again, engage@camaplan.com. But as you can see, 10 and 15% returns do way better than 5%. And then the next question people are going to ask is, where do I get a 15% return? The answer, we actually have, one of the examples I have in here today is 14%, and it's very easy to get that. It's pretty similar to most of the formulas that most real estate investors utilize. What is unrelated business taxable income? Okay, you guys can read what it is, but what it means is when your IRA, 401k makes money outside of exempted entities such as interest and rental, real estate, et cetera, that's tax that your IRA, or that's income that your IRA must pay tax on. And if you, let me take a look at my notes on it, right? So if your IRA is running an operating business or your 401k, it's a tax on everything in that business. If your IRA borrows money, as an example, it can be used for the tax or the lending part of that purchase. So our example is going to show a $250,000 residential condo that borrows half of that money. So it would be split 50-50, and the taxable income would be 50% of that income from that rental property. That's different from unrelated business income tax. That's the tax, basically an income tax on your IRA for the amount of money that it made. In the previous example, you could have a piece of property like we were talking about where you've had it 50-50, then you would put that down. You'd see how much money you made after expenses and depreciation, and then your IRA 401k entity would pay an income tax on that amount based at trust rates. What is unrelated debt financed income tax? Again, that's if you borrow money, that share of it will be that 50% in our example will have to be paid income tax on that amount of money, again at trust rates, with the exception of the system. So just keep UBTI, UBIT, and UDFI separate. UDFI is unrelated debt financed income. So we'll do it. So I know that's a lot of definitions, etc., but what we want to look at, this makes it a little simpler in my mind. At the top, you have unrelated business taxable income. There's two lines for that. The one, when you're looking at your screen, the one on the left is, for example, if your IRA bought an operating business, such as a franchise, a Kentucky Fried Chicken, a Midas Muffler Shop, a Rita's Ice, you'd make money on that business, and every year you would be paying close to 37% on that money, but I'll show you those rates in a minute. If you sold that business in several years and you still had at that point, you would have capital gains tax, and that business would be sold, and any of the capital gains would be in the long-term capital gains rates. And I have those rates today too. On the other side, you have debt financed property. In this case, your tax deferred account buys a unrelated or puts an unrelated debt on to the acquisition of the purchase. Again, you pay $250, you put $125,000 loan on the property. At that point, you will pay a tax on 50% of the income underneath that in this block. If you sold that property in, let's say, 3, 4, 5 years, and you had the loan paid off, you'd pay no UBIT tax if you had that loan paid off ahead of time by a year. If you didn't have the loan paid off, you'd pay on the capital gains rate at the long-term rate, which is the max is 20%, but we'll go over how that works here shortly. One of the other things that I want to talk about is if it's a 401k, a lot of times unrelated business income tax is not required if it meets several of the exemptions. Like 401ks are not subject to UDFI unless it's owner financing or a seller leaseback, or payments can be contingent on timing. It has to be a fixed mortgage debt without the owner or the seller getting any benefits from it. On the other hand, if it's an IRA, basically it's required to pay UDFI unless it's used for government housing or Section 8 property. So I just want people to understand that's a lot of rules that people don't understand, and that it's a lot of times easy to get around if you do the proper planning. At this point, let's talk about how do you know if you've got to pay UBIT, right? K1 Part 3, which is this area here, based on the income. In this case, it's ordinary business income. That should let you understand that there will be UBIT tax on that $4,000. However, if it was down here in Section 5, interest income, you wouldn't need to pay taxes on that. So these categories here help you understand whether or not it's taxable or not. And if you want to make sure that your IRA is being the one verified, your IRA, when it has to pay unrelated business taxable income, they have to have a tax identification number. In this case, make sure this does not match your Social Security number. Otherwise, it's supposed to be showing up on your personal return. And then on line 11, you should see that it's an IRA, et cetera, in this area here. IRA, 401k. Now, as an example, a lot of times you'll be in a multifamily fund or syndication with leverage that they may have taken part of the down payment from your contributions or your IRA contribution, your accounts. But if leverage involved, there's a percentage of that leverage that would trigger UDFI. So always look at that and ask the people running your fund or your syndication whether or not UBTI or UDFI is involved in this. If you don't know, let us know and we'll help you get through those issues. So that's okay. One look at it. Let's go to the next slide. Unrelated. So let's kind of talk about where we are here. Unrelated trade or business income. If you have that, you're going to have a 990 team, right? Form Schedule A, Part 1, 2, and 3. That's for running a business. Franchises, LLCs, Midas Company, property management. These are all types of things that fall under that category. Rent from real property and personal property. Again, that's a Form 990T from the IRS, Schedule A, Part 4. These schedules are a lot like your schedules on your 1040 if you own real estate. In this case, let's say you owned a Airbnb, you were renting the property out, but at that Airbnb you had bikes that were additional pricing, grills, barbecue grills, cribs, hospital beds, appliances, a pool heater that were rented separate from the property. At that point, you would go to 990T Form Schedule A, Part 4. And then if you bought a piece of property and you put debt against it, you'd go into 990T Form Schedule A, Part 5, which is IRA borrowing for the purchase of real estate. So any questions that anybody has, put them up in the Q&A and I'll get to them at the end of this stuff. But these are the types of things that are most prevalent in using self-directed accounts, specifically at Camaplan. So this is one of the things that people have asked us for, and you can Google this and you can find them in the IRS.gov. There's tables there for it. But for 2023, trust tax rates are over here. 0 to 2,900 is 10%. 2,900 to 10,500 gets taxed at 24%. 10,000 to 14,450 gets taxed at 35%, and above 14,451 gets taxed at 37%. I can't go over all the spreadsheets, although I've got an engineering background, because my partner tells me it puts everybody to sleep and they'll start getting off of the presentation. But let's just say your income was $10,000, right? So 0 to 2,900 is going to get taxed at 10%. So you made the 2,900, so that's going to be $290. 24% then out of 7,099 is going to get taxed at 24%. So that's going to equal $1,703. So you add the 1,703 to the 290, and you come up with 1,993. So that's how, or the 2,901 minus the 10,000, 1,763. So all the earnings equals the 10,000. This is the same exact slide I showed you, but if you look, 2024 trust tax rates went up a little bit for inflation, right? And you can look at the brackets for them, and everybody will get charged the 10% to 24 and the 35, and then anything over 15,200 gets it at 37%. This is putting the 23 and the 24 taxes comparison to them. You can see the rates went up 3,000 to 150, 14,649 to 15,450, and 14,650 to 20. So that's what the rates are today. So let's go over Form 990T. All right, I actually blew these up a little bit, but part 1, 2, and 3, total unrelated income tax. This will come from our example that we're going to show. In this section B, you pick these categories here, right? 408E is right here is for traditional IRAs, SEPs, and simples. 408A is for Roths. And then the ESA is in 530A, and pensions are in 5.1, and then in that category you put a small a next to it. So these just are for the different types of entities that are here. The other ones that I didn't mention are for hospitals and universities and different things in that category. So in the example you're going to see is the income came from a residential condo. When we figured it out on Schedule A, the amount was $24.99. I'm working this a little bit backwards, but out of that $24.99, because it's an IRA, you get $1,000 deductible. So you're going to be paying on $14.99 taxable income. When you put that into the rate schedule, your tax is going to be $149. And you take it all the way down to the back of the section, in there. The tax payment's going to be $149 out of the the 30,000 gross income for the property. And we'll get into more details shortly here. You do need a 10 for these forms, and we should be in good shape for that. At this point, we have ordinary income calculator. If you want this, I just showed you those forms. You can determine the UBTI by filling these in. This is just an Excel spreadsheet, but it's set up to give you the 2024 tax rates that we use. And this tool actually works, but I'm not going to put it through at this point in time when you do get it. So here's the example that we're talking about. Here's our assumptions. It's a residential condo. The purchase price is $250,000. The value of the structure is $250,000. The land value is $500,000. An acquisition, $5,000. An acquisition cost is $5,000. The IRA down payment was $125,000 in this column here, and the loan was a 7% 30-year ARM with $125,000. So the initial debt purchase price is 50%. The first year rental income is $30,000. All right, so this is Schedule A, Part 5, unrelated debt financed income. So on line 2 of that schedule, which I showed you a little earlier, we have the gross income of $30,000. We have depreciation, straight line depreciation of $9,090. The expenses down here, homeowners association, tax, insurance, interest, maintenance and interest, total $15,912. So that's where these expenses come from. They may be more or less, but in this case, this was what the condo paid. Total expenses is adding the 15 and the 9, coming up with $25,000, and that's the total expenses with depreciation. Acquisition debt average for the year was actually a little bit less than that, but in this case, in line 4, it's $125,000. And the acquisition cost, when you put it there, is $250,000. So 4 divided by 5 is 0.5 or 50%. 2 times line 6, right? 2 times line 6, which is half, is 15,000. Total gross income attributable to the debt portion of the property is 15,000. Allocable deductions is half of 25,000. So you're 12,500, which is again just 3C times 6, which is a half. So that's your total allocable deductions. UBIT schedule line part 1 ends up being 2498, which is 15 minus 12,501. And you just saw on the 990T, we had 2499 because we rounded up. And when you put that into the calculator, you saw that it equaled the 149. But what I want you to do here is, that's all great. That's simple. The rent is $2,500 a month, which follows the 1% rule. When I purchase property, that's the most I'll ever pay based on the rent. But the cash flow ends up being $14,088 because of the depreciation, and it's basically 30,000 minus the 15,912 for the expenses. So you end up with $14,088 for cash. You pay your $149 in taxes, which is 1%, and your total cash flow for the IRA is $13,939. But I want you guys to write down that, 14,000 there or close to it, and also the cash on cash return, which is right next to it there, in the bottom is 11%. And again, this is a 50-50 example, and I'm going to show you the next slide here, which is 70-30, 70% loan, 30% down payment, the exact same, another condo in the building, right? 250,000. You bought it, the structure's 250, the land is 5,000, the acquisition cost is 5,000. The IRA down payment right here, 75,000, and the loan at 175,000. So your debt to purchase ratio is 0.7. Again, that goes over here. You figure that out from your chart going up there. Line 2 is still 30,000. Depreciation doesn't change. Your expenses do change because your interest has gone up. In the program down here, your total expenses is 19,393, right? You add those two up and your expenses go to 28,483, where before they were 25,000. So at that point, your total gross income now is 21,000 attributed to the 30,000 and multiplying it by 0.7 times 30 is 21,000. And then your allocable deductions again is 0.7 times the 28,000, which is 19,000. So you're going to pay tax on $1,061 at that point, and your tax ends up being $6 for that income, because you have $1,000 deductible, so your income will be on $61. And as you remember, at the 10% level, it's $6 as shown down here. So your cash flow goes to 10,607 from the 14,000 on the last one. Your tax is less, it's $6, and your total cash flow minus the $6 is 10,601. But look over here, your cash on cash return goes from 11% to 14%. So I just want you to think about that. There's no right or wrong answer how you want to do this. If you had bought this all cash, that would go down to less than 10% based on these numbers. You guys can work that out yourselves. And which one is better, having the 14,000 cash flow or the 10,600 cash flow? Having a cash on cash return of 11% or a cash on cash of 14%. It depends on where you are in your goals and how old you are, et cetera, and your tax rate. But in this case, the IRA puts away $10,601 and is basically paying, less than 1% tax. So I don't want UBIT scaring people, because everybody's usually, oh, I don't want to pay UBIT, it's a hassle. I didn't put the cost. It's probably $300 to do a UBIT tax return if you're going to make over $1,000. And by the way, that's the limit. If you don't have taxable income more than 1,000, you don't have to do these returns. So again, now we're back on to Schedule A, page 1. You saw that 24.99 was calculated, 15,000 minus the expenses came up with 24.99, which went into this category right here and filled these things in, and then also goes on the 990T, which you saw earlier. Let me, I see several questions have popped up. Let me take a break and look at those questions. What's the difference between UBIT and UDFI on this slide? Level 3 and level 4 blocks are the same. I'm sorry, I don't know what slide that was. So if I understand, I'll go back to it in a minute. So I understand correctly, if I am doing secured loans that get an interest rate back plus principal, if I have a 10, there would be no UBIT. If you're lending money and you're getting interest and principal back, there is no UBIT. Okay, this is if you're buying property. Lending money is interest only income, and it's exempt from UBIT. And that's whether you have a 10 or not. I think it's a good idea to have a 10 just in case for some reason they don't pay you back and you don't get your money back. You can at least report them to the IRS, and they can pay a tax on the loan you gave them as income. I have 2 rental houses in my CAMA SDIRA. Do I have UBTI? Do I need to fill out a 990T and pay taxes on them, on my rental income? Question I have to ask you is, do you have a loan on them, and how much do you make? If you make, if you're doing this, you have to figure out whether or not you have tax. If you don't have a loan on them, no, you don't have to pay UBTI. Again, talk to your accountant or give us a call and we'll help you through it. With just this little detail, I can't answer you. And by the way, I think filling them out, especially if you have a loss, that you can carry forward so that when you do start making money, it'll be less. I always get late K1s. Do you have to deal with quarterly estimated payments, and how would you know what to pay when you file for an extension? Okay, so that's a great question. The answer is you can figure it out from last year's tax return and you won't be penalized, and say, hey, I think I'm going to do the same as I did last year, and then pay those estimated taxes. I have a slide on that and we'll talk about it in a little bit. Hopefully I have that information on it. So in short, for the UDFI, and the loan to value percentage is the percentage of your income as UDFI. Is that all you are trying to say? The percentage of debt to income, or no, it's debt to purchase price. And as an example, if you have an amortizing loan, that debt is going to go down every year, right? Or you might make extra payments to it and that debt is going to go down. And then, right now in our example, it was 50-50. It was the first year. In reality, you would have gone down $500, but it didn't change the numbers, so I left it is that way. But let's say it went down $25,000. That loan to purchase value, not loan to value, but loan to purchase value would be going down. And at that point in time, instead of 50-50, it could be 55-45 or 60-40, and you'd only be able to take 40% of the expenses and depreciation, but you'd only be paying tax on 40% of the income. So I hope that answered that question. Can you provide an example of the effect on sale, assuming all the debt remains at the time of the sale? I can, right? So we can take if you take that same example of 30,000, I don't have it drawn out right now, but if you write me and ask me for that, we'll do that. If you take that 30,000 that was there and figure out your expenses just like you would on your own tax return, and then take that income that you made minus the expenses and minus the depreciation, tell me what that number is, and then I would figure out in the charts how much you'd pay. But the worst it's going to be is 37% of that income that you made on that property. But I've never seen one that's been like that. And in most cases, when you first buy a property, you're at a loss or close to breaking even. It's as you get along further and further down the line and later that your rents go up, etc. Okay, so that the chart from David was the org chart. So yeah, I'll go back to that after I answer, see if there's any more one there. How does UBIT apply to the Roth IRA? Exactly the same as it does to the traditionals, etc. There is no difference in the Roth versus the traditionals. However, I would caution you against using loans for traditional IRAs. I don't like that. Very limited number of cases would I would put my property in a Roth if I'm going to take a loan on it. And the reason is because you have to pay ordinary income tax on that money after it comes out, and you've already paid UDFI tax on it or UBIT tax on that money. So be very cautious if you're not in a tax-free account, and we can talk about that later. And if you call the office and set up an appointment. If you refinance a property purchased cash, how do you calculate the loan to purchase price? If you refinance a property you purchased for cash, how do you calculate the loan to purchase price? This is acquisition when you buy the property. If you refinance a property and you purchase cash, the question is, what are you doing with that cash? And that's where the UBIT goes on. So let's say you refinance the property in your Roth IRA that you bought for $100,000 and it's now worth $150,000, and you get, let's say, $100,000 out of it, but then you take that $100,000 and buy another property. When you buy that other property, that loan goes against that new property that you've bought. So if you bought that new property for $250,000, you're going to have a $100,000 UBTI loan that's on that property for $150,000. I hope that answers your question. And let me go back and read. David's question up here. What's the difference between UBIT and UDFI on this slide? Let me go back. So I believe this is the chart that Dave was talking about. What's the difference between unrelated debt financed income and UBTI? Well, in this case here, right, this is if you bought a Midas muffler shop or a Rita's Ice or some other franchise, or you bought into a property management company, all the income that came from that business that your IRA bought would be income at this point. Over here, it's related to the debt financed income, right? Which is a portion of it. This is pretty easy to calculate. It's whatever the income is that comes into the business, or whatever percentage of income that your IRA would get from the business, which needs to be a pro rata share. Over here, this is if your IRA borrowed money for something, and it was, for a house or a condo, or was in a multifamily syndication that borrowed money. It would fall under this category. And the only difference is they fall on different parts of the 990T and the Schedule A. So I hope that answers your question. Let me go back up here, or does it make more questions? Let's see. You mentioned $300 preparation fee for UBIT tax return. Can you provide the name of a tax professional who has such a low fee, or out there charge $1,800? They are few and far between, mostly on the West Coast. Yeah, call the office. We're not allowed to provide names and that, but we will. If you call up, we'll give you a list of them. I don't have them for this presentation. And obviously it depends on what information they're giving and how easy it is. The first one may be more, but we can look at that and see. If you have 15 properties or one property, I think that'll make a difference from where it is. At what income threshold does an alternative minimum tax kick in when figuring UBIT? I don't know the answer to that, Matt. We'll get an answer for that. You have to figure it out, and in most cases, they've been less. I don't know that I've seen one over what you have to pay otherwise. So let me get back to where we were. I think we saw these slides. We were there. So in this case, we came up with the 1201 to 2499. We've already talked about that. Total dividend, total taxable income is 2499. You put that on these sheets are blank because we were only dealing with those sections, right? So a lot of people don't know that plans can borrow money, right, using non-recourse loans. Many investors are limited in borrowing money for many reasons, right? Their debt to income, they have too many investment properties, and or their credit score is low. None of that matters because your Roth IRA will get a 10 and it'll be based on that. None of these factors matter when you have a separate 10. It's not associated with your debt. So a lot of people find that advantageous. If you are going to borrow money, I want you to consider these things, right, as a minimum. Tax deferred or tax free. I told you my feeling on that. I think it should always be tax free. I've seen a couple examples where they've done it with a traditional and then converted to a Roth because they had a diminishment in the purchase price. Short-term capital gains versus long-term capital gains. You saw the difference in the rates. Short-term capital gains or income, ordinary income can go to 37% very quickly. The long-term capital gains taps out at 20% before that. Retirement and taxed income related to Social Security, age, and required minimum distributions. How close are you to that? And how will that affect your income and conversions, et cetera? obviously figure out whether or not you have unrelated business income tax. And I'm going to show you a chart in a little bit about what states charge you money, which states don't. I'll show you a map of that in a couple of minutes. And then what if you're already in your tax rate at 37% if you're a high net worth earner? That's, notable ones are Mitt Romney. When he ran, he gave his tax returns, and Peter Thiel was in the news last year for having a $1 billion Roth IRA. He's already paying 37%. Would you rather have your money going into your bank account, or would you rather it going into a Roth IRA or a Roth 401k that's protected from creditors and liens from most individuals in judgment? So a lot of the wealthy, if you're already in that high tax bracket, you might want to consider having your IRA own a business or do the other investments that we've talked about here. People don't think about that, maybe because they're not in that tax bracket. But if you are, that's something to think about. All right, non-recourse loan simply means the security instruments, notes, and mortgages allow no recourse against the individual account holder or the balance in your retirement account. All they can go against is the property that's up on the mortgage. In the event of a default or foreclosure, the property is the only source of repayment. Non-recourse lender can't pursue other assets owned by your individual or the IRA. Non-recourse loans are generally less cumbersome than personal loans. No income verification, no employment verification. The rate is not based on any credit reporting or credit scoring. And closing costs, associated fees are similar to traditional ones. And normally I'd have a non-recourse lender slide here, but we haven't updated it yet this year. And I just want to make sure everybody's doing it. If you want that, again, engage at Camaplan for any of these slides. IRS rules, who calculates, pays, and when, right? 990T form, tax ID number, and Schedule A. There are other forms that could get involved depending on what you did, but for most IRAs, 401ks doing real estate, these are the forms that you need. I'll go over the penalties and fines, and then we'll talk about UBIT blockers, such as Rob, C Corp, and special funds. Right, 990T form, got to have a tax ID number and Schedule A. The IRA owner is ultimately responsible, as in everything in your life. Your accountant can calculate the return. Your administrator can help them, feed them the information from your account as requested. The administrator will sign off on behalf of the IRA after the owner verifies the return. The IRA pays the tax, and the administrator will send the money when the owner authorizes payment. Electronic filing is encouraged, but in some instances, you can still use mail. Ask your administrator for the details. IRAs are required to be in 15th day of the 4th month from the fiscal year end. As if you did the December 31st, it would be April 15th. If your fiscal year ended like the government does on in October, it would be January 15th that your tax return was due. In 401ks, it's the 15th day of the 5th month from the fiscal year end. There we go. Rules and penalties, right? Interest on taxes not paid, they're going to charge you the going rate of interest on taxes you didn't pay on time. And that includes, the estimated tax penalty. Late filing, 5% of the unpaid tax. If you file late, will be put on top of the penalties. Late payment of 0.5% per month, not to exceed 25% of the unpaid tax. If you haven't paid it, estimated tax penalty. If you're supposed to do estimated penalties, non-payment can result in $500 fine, and you're going to have to fill out Form 6655, which can give you some reason for not doing it. But you can either have your accountant figure it out ahead of time, or you can use the last year's tax amount. And then there's other fines out there if there's negligence, substantial understatement of the tax, and or fraud associated with it. Fraud, with the exception of fraud being in there, all of these things are dollars. You're not going to go to jail. You're not going to go to jail for them. That's the good news, right? So, next one, types of self-directed plans. The ones on the left are traditional accounts. These I do not like using with UBIT unless you're already in the, even at that point, if you take a look at Peter Thiel, he did it in his Roth IRA. I would definitely put the money in the tax-free side so you can avoid double taxation. Which account is best for me? Again, I would suggest you look at the tax-free ones. And it's not what account, it should be how many accounts should you have. You saw this chart. Did I skip one or not? No. You saw this chart last week. It's basically try to do things in your Roth. You don't, everything you get in your Roth's 100% yours. The traditionals, you don't know what the tax rate's going to be or how much you're going to have to take out based on your RMDs as you get older. So think about those as you're going through. I talked about the UBIT blockers, rollover business startups. A lot of people will take their 401k and buy a franchise. They might buy 50% of it themselves and 50% in their C Corp rollover business startup. And it's not that you get away from paying taxes, but you move that portion that's in the ROBs or the C Corp from a 37% tax down to a maximum of 20% tax, which is, significant. Special funds. Now, a lot of people have done a debt fund, like one of the questions that were asked today. If I'm lend money and I'm getting paid back principal and interest, or just interest, I don't need UBIT. Yes, that's 100% right. If you're in a debt fund, you can do that, or a feeder fund. Let's say you've got an IRA and you wanted to invest in a multifamily syndication or fund. That multifamily might build two funds, one for IRAs and one's for people that want to hold equity. And to make it equal to them, I've seen them where they give a specific interest rate out to the people in the feeder fund, but they also have a participation clause in there that in certain conditions are met, they have a potential for increasing that interest rate up to on the upside, right? Avoiding UBTI, because the main crux of the note is to be loaned. And how you structure your deal, this is very important. A lot of people say, well, I want to own the property in my IRA. I'm going to go out and I'm going to borrow money from a bank or another IRA or somebody's business. And then they're gonna have UBIT because they bought that. I've seen people joint venture with other people and say, hey, if you give me 50% of the money, I'll JV with you for 25% of this property, depending on the value of the property. Limited partnerships is another way to do it. I've seen them assign 50% of a contract for 100% of the money. And then there's options out there. So we'll talk about these types of deal structuring in next month's Jumpstart Your IRA. That's stuff you can do with a little bit of money versus borrowing money on these cases. So these are ways around UBIT or at least minimizing the effect of UBIT. These are the marginal tax rates. I just want to, a lot of people don't see these, but this is for married couples. They have singles, head of households, married couples filing separately. But look at these so you know where you fall, because just like those tax rates that were in the trust tax rates, you can see you get up to almost 487 at 32%, and you have to make 731,000 to get in the total 37% tax rate. So that's going to put you in the federal income tax at these brackets. So just for your own personal edification, somebody says, well, I make 731,000, but that's not all at 37%. That's at 196,000 in taxes, which is a combination of all these taxes going up. You can see, however, that it is progressive. This chart here, like for you to understand that the dark green are states that have no income tax. Florida, Texas, Nevada, Washington, South Dakota, and Wyoming. The light green is they exempt all retirement income. So this should, the greens are states you should definitely look at if you're going to retire and take money out of it. As an example, if I lived in Florida and I moved to North Carolina and started taking my retirement, I would have to pay income tax on my IRAs and 401ks. And the very light green exempts some retirement income, and you'd have to check each state for that based on where you are. And the light blue, unfortunately taxes it all. Hope you find this chart helpful when you're planning your retirement and where you're going to live. Open a self-directed IRA with CAMA plan. Basically, if you open up an account because you're a member of a RIA or national RIA, there's no annual fees unless you have an asset in your account other than cash. So you don't have to worry about us taking annual fees as long as you have $4,000 or more cash in your account and no assets. You get free consultation with the CAMA plan founder, get 30 minutes with myself or Maggie. You get 1 year VIP customer service, 1 free expedited transaction, 2 complimentary outgoing wires. The main thing is get your account open. This right here, many people like it because they don't feel rushed to get their money invested in anything, and they can wait for the investment that they want, and they can do the due diligence that they want. Next slide. All right, so this is kind of what we went over. I see I've got a couple more questions there, but you guys learned how IRAs can borrow money from banks and what the consequences are. Understanding UBIT when it comes into play. Hopefully you know that. Determining who pays how much and when. Hope you have those issues there. We're running out of time, but let me try to get these last 2 questions in there. Hope I am. At what income threshold does the alternative minimum? I have to get that answer for you. I don't know. I can't remember. You know, this IRS stuff is, and tax returns are very boring to me. I use them instead of Ambien when I can't sleep. If you're a Class C owner where you've loaned money to purchase the land for a multifamily housing, but you aren't involved in the ownership of the property, do you pay UBIT on the interest earned? Or if you've loaned money and you aren't involved in the ownership of the property, in most cases, you're not going to pay UBIT. Interest earned is not in that category. Interest from loans are exempt from that. It's your money went into it. If you buy a house all cash, you don't have to worry about UBIT or UDFI, right? If you don't buy an operating business, you don't have to worry about it. If you don't get payments on rental property for appliances, grills, beds as separate rentals, then you don't have to worry about UBTI. So I hope that answers your question. Any loans are there, but always check with your accountant. And obviously, we'll be glad to get on a call if you're our clients with you and your accountant and go over where the answers are in the code, etc. Because I do not want to get hit with practicing accounting or law without a license, as we said in the disclaimer. So everything here, I want you to verify with your professional advisors. Somebody said, thank you. Let me just check the chat, and sometimes people do that. Who can, okay, so we don't have any there. All right, we're at 7:30. Again, if you want any of these slides or tools, please write engage@camaplan.com. And let's make sure we're at the, let me get rid of this slide. I just want to show you guys what we're doing. Next week, right? Next session, we've done understanding self-directed IRAs. We've now talked about UBIT. We're going to talk about jumpstarting your IRA and 401k. And by the way, I like that way more than this UBIT and what it is and how it works. That's boring to me, and it's not one of my favorite subjects. So I'm sorry about that. 821, we're going to jumpstart with advanced strategies. Learn how to grow your account. We're going to talk about strategies and structures that we touched on today. We've got a 20 ways to invest in real estate with minimal cash that you're welcome to have for free. It's on our website, but we'll talk about that. We'll identify low cost yet lucrative deals that you can do for a little bit of money, and we'll talk about backdoor Roths. So hopefully that's interesting to you guys. Again, call or talk to an account executive, engage@camaplan.com. This number 866-559-4430 is a specific number for National RIA members that'll get you access to an executive sooner. And check on our website for any other workshops and webinars. But make sure you schedule the 821. Put it in your calendars now, 6:30 p.m. for that. Especially if you like this one, I guarantee you'll like the next one better. Hopefully everybody is good with this. Let me see, a couple more questions came in, I think. Let me just make sure. Good presentation. I hope everyone is well. Thank you. Thank you. All right, everybody. Thanks a lot for the for showing up tonight. I know it's summertime and there's things to do. So we'll see you next week.